Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Stocks have rallied to record highs while the Iran war is merely paused, oil prices are elevated, and inflation remains sticky. But while equity investors cheer the recovery, is the bond market quietly telling a different story?
We ask whether this rally can keep climbing the wall of worry, or does something have to give? And in today's dumb question of the week, what is the crack spread? All right, let's get into it. So the S&P 500 just delivered a third straight weekly gain of more than 3%, something it hasn't done since 2002. And the Nasdaq Composite is just coming off a 13-day winning streak, which is only done once in 4 decades. So it's been a blistering rally, faster even than the Liberation Day tariff bounce back last year. And a lot of people are saying this is a weird market. It's the most hated rally, all of this stuff. But I kind of wanted to ask you to start off, Roman, is this even that weird? Isn't there a phrase on Wall Street that buy when the bombs fly? I've heard that before.
I haven't heard that one. I think what's happened is that equity markets have looked through it and they're pretty much looking forward to what's going to happen after this. And also looking at the impact on US earnings, which hasn't been that huge. Some of it's been positive in the oil sector, and we haven't seen the slower effects which come via inflation, at least not yet.
I mean, the tech sector has had a massive upgrade in earnings for the second half of 2026.
Yeah, and that's where we've seen a lot of the big bounce backs. So, yeah, I mean, it's certainly looking good if you're a global index investor. We're already past where we were before the bombs did start flying. So, new all-time highs for global equity funds like ACWI. Now, remember that this is not a resolved situation. It's not the case that we've had any kind of lasting ceasefire or any kind of resolution of the fundamental problems, which is the original goal, remember, was regime change, I think, in the Middle East. And yet that's not what we've achieved.
Trump says we have got regime change. We've got a different Khomeini in charge, Roman. Don't you class that as regime change?
That would be a very nuanced reading of it. But I don't think that anything has really changed since before the war, other than Iran showing that it can close the Strait of Hormuz and having done so. And in fact, Gideon Rachman in the FT has written an article just this morning as we record this, talking about how this could just be the beginning of this conflict. So I think equity markets always are optimistic. They always have the glass half full. Bond markets, on the other hand, have the glass half empty.
Is that the dynamic we're seeing now, though? Are bond markets a little bit nervous, even though it's not really making the headlines so much?
Yeah, if you look at 10-year yields in the US, they've been pretty much tracking the price of oil. As the price of oil goes up, so do the yields on treasuries, which mean the prices go down. At the shorter end of the curve, I think maybe there was a bit of a misreading there because we went from a world of rate cuts to rate hikes, and maybe too many rate hikes were priced in. I think central banks will try and look through this inflation spike, and that's going to limit what happens at the short end of the curve.
So it's the long term that the bond market's more worried about. And is that some combination of the fact we've got elevated debt to GDP levels in the US and elsewhere, sticky inflation, which means rates are unlikely to fall as quickly as hoped, and people in power who might not really care about bringing inflation down?
And certainly not care as much about the oil price. Remember that the US really does benefit in some ways from this conflict in terms of its oil revenue. So it feels a bit unfair sitting here in the UK, which is that we pay the price and the US doesn't pay such a heavy price. And if we look at the situation in the UK coming into this, well, there were actually signs that things were improving in terms of growth, in terms of inflation falling. So really, it's quite annoying that this has happened.
The turnaround moment seemed to come when that 2-week ceasefire was announced. That's what started off this extremely fast bounce back in stock prices. Do you think that was just traders taking the ceasefire as an indication that this is all over now? We might not have a final agreement signed, but Trump clearly wants out. You'd have to think Iran wants the same, though on its terms if it can get them. And therefore, stock markets do what they do. They're optimistic. They say, Where we're going to be in 3 months' time is more like a normalization of oil flows. Therefore, let's not worry about those input costs quite so much. Is that what's gone on?
Well, I think you've always got to look at the behind the scenes movements in fundamentals. And what we're seeing is still fairly good, very good, in fact, earnings growth numbers coming from those mega caps tech stocks and frankly, the rest of the S&P 500. Now, you can question whether those brokers are telling the truth, whether they've got it right. But really, if that's happening and you're looking at a depressed price, well, earnings are going to pull things up eventually. So equity markets can still see a bargain. I think there isn't enough fear in the market at the moment that it's going to drag down valuations. So we're not going to see a derating, put it that way. People are not going to pay less for the same amount of earnings as they would normally. I'd say what we're in is a kind of temporary abeyance of euphoria, and it's very easy for that euphoria to snap back.
I saw a good tweet from Mike Bird of The Economist this morning, where he posted a graph of the S&P 500's 12-month forward earnings per share expectations and how they've changed on a year earlier. And it's quite clear that earnings expectations for American stocks are rising faster at the moment than even after those 2017 tax cuts, which you remember was just mechanically feeding money through into the bottom line and boosting earnings for US companies. And now we're seeing an even bigger jump than that, despite everything going on in the world. As you say, whether that's going to be delivered, we don't know. But it certainly seems like the American profit juggernaut is not stopping quite yet.
I think it's probably worthwhile breaking down the fundamentals in terms of when they're accounted for. For example, if you look at the capex spend, a lot of that isn't accounted for in the same way as profit expectations. The profit expectation surge is much more front-loaded, whereas the capex stuff happens further down the road. So maybe what we're seeing is a delayed effect of that capex, which ultimately will produce a dampening effect on the euphoria.
I've seen people make that point, which is that what we've got going on in the S&P 500 is one section of it passing a bucket load of money over to another section of it. So basically the hyperscalers, Microsoft, Meta, Alphabet, are getting as much cash as they possibly can from their balance sheet and handing it to Nvidia and Broadcom and a few other people that make chips. And what Nvidia do, obviously, is they recognize that money as sales today. They've sold the chips. But what Meta and Microsoft do on the other side of the coin is they amortize that spend over a few years, as is normal accounting practice. So at an index level, it looks like we've got loads of money coming in today without the cost today, exactly as you said. And we saw this dynamic, you know what I'm going to say, Roman, we saw this dynamic at the end of the 90s in that huge internet build out. Who knows if it'll play out the same way today?
And then bubbling up behind the scenes, what we've got is a credit problem, which is in private credit, with a lot of these funds being gated, with spreads widening, with a pretty much opaque market. Because a lot of that bad credit, companies that couldn't get loans via the usual routes, they've borrowed in the private credit market. So I think that eventually is going to come home to roost, and that could act as an accelerator for any kind of risk-off move. So I think we've got the kind of tinder in place there for what could potentially be quite painful. And if there is disappointment in earnings from any of the mega cap 7, then that could produce the sparks. But look, I'm not going to call a massive sell-off here. I think that it's still the case that the US economy is pretty strong. We are seeing a little bit of a wobble in the labor market. We've definitely seen a stagflationary shock across much of the rest of the world, particularly countries which are very dependent on energy imports, fossil fuel energy imports, like the UK, like India, like a lot of Asia. But for the US, I still think it's looking fairly robust given everything that's going on. And look, if you live in Texas, this is great times. Oil prices are high, they're pumping, there's a president in power who's very much in favor of that. So times are good.
You'd think so, but they're all annoyed about the gas price, the price at the pump. You think I'm joking, but consumer sentiment in the US just posted its lowest ever reading. This is how people respond to surveys. They are not happy about the economy, primarily, I think, because of the fuel price and concerns about inflation and this K-shaped recovery where the perception is the rich are getting richer, everyone else not so much. But then Treasury Secretary Scott Bessent made the point that if you look at the hard numbers, people are still spending. So how concerned can they really be about their finances?
And if you look at the opinion polls, people are very unhappy about what's going on in the economy in the US, and that's definitely going to have an effect on the midterms. But you're right, I was shocked by those consumer sentiment surveys because in the US, that's considered to be a major driver of equity markets because it is basically a consumer driven economy. And if consumers aren't going out and buying, if they're not getting in their SUVs, going to the mall, buying stuff, well, that's pretty bad for the US economy. Whereas what the focus seems to be on at the moment is that capex spend, which is feeding into growth at the macro level.
I think this recent rally has just reinforced again the importance of that capex spending and how it's kind of saving the economy at the moment. Because we put in the newsletter that around 45% of the gain in the US stock market in recent weeks has come from just 5 stocks: Broadcom, Meta, Alphabet, Amazon, and Nvidia, those big tech companies that you expect. But 5 of the 500 stocks in the index driving almost half the rally. That's not a broad market, is it?
And whenever you have such narrow leadership, that always makes you worry about the sustainability of the rally.
The other thing I'd seen said, Romin, is that once that ceasefire was announced and people decided to be a little bit more risk on again, what happened behind the scenes in the market was a few technical factors which reinforced the rally. So anyone who was short was kind of forced to cover and buy stock, which amplifies the gain. And also, after the first week, a lot of those trend-following funds, which have quite a bit of capital in the US, flipped from short to long. So we had a kind of self-reinforcing momentum. I don't know, do you think that played a big role, or is it more about everyone just deciding to buy the dip?
I think it's both of those. I think it's still the case that people are conditioned to think if equity markets go down, it's a bargain and I'm going to buy. We still feel that way. And we're just so far from capitulation, from a market in which people just are not interested in stocks, where they don't believe they're going to rally 10, 20% over the next year, that I just don't believe that a lot of retail investor buying isn't behind this rally. But if you look at the fund managers survey, this is a survey done by the Bank of America, 69% of their participants expect higher inflation. 36% expect weaker growth. And that's the biggest bearish sentiment in terms of growth over the last 10 months.
What's their positioning, though? Are they underweight stocks?
For global equities, they have cut their overweight from 37% in March, 48% in Feb, all the way to 13% overweight equity. So that suggests that there's less risk appetite amongst fund managers, at least.
So they're just slightly smaller bulls.
Well, in terms of size of assets under management, it's about $0.6 trillion. So pretty hefty. That's a lot of beef.
Oh, yeah, they've got a lot of beef, but they're a little bit less bullish than they were.
Yeah, that's right. That's right. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code ROMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, so we've talked about the war a little bit. We've talked about the concerns around persistent inflation. But one of the big concerns for investors that we haven't really touched on, that's always there, is what is the Fed going to do? Now, we've got a new Fed chair supposedly starting next month, if he gets confirmed. What's your sense? Because this seems to be flip-flopping all the time about where monetary policy is going.
Yeah, I mean, Trump has started talking about firing Powell again. And obviously, that's going to put a spanner in the works when it gets to confirming Walsh in his role.
Sorry, should we explain that for people? Because Powell's leaving as Fed chair. What's he talking about firing him for? What does this mean?
So if he stays as one of the Fed board, then Trump says he's going to fire him. He hasn't actually said whether he's decided to do that after he ends his role as Fed chair.
Don't you think it would be a bit weird if the old Fed chair just sort of sat there on the board? It's like a backseat driver. It's like when the CEO leaves and becomes chair of the company. You think, well, that new CEO, how much authority is he going to have?
Will he have less power than he would as someone who's chair? I think it'll be really useful to have him there as someone that the new Fed chair can sound out about what to do.
Yeah, I mean, he can sound him out anyway. He doesn't have to be sat there in the same room. I just wonder, like, the Fed chair is just a title, right? Imagine if the rest of the board said, no, Walsh, we're talking to Powell. He's still here. Like, it doesn't matter. They just vote, right? I don't know. It's one of those rare issues where I can actually see it both ways.
Yeah, the Fed chair doesn't have the power to really sway the vote, not officially anyway. But look, Walsh is coming into this job as someone who says that he thinks tech is going to be massively disinflationary. It reduces the rate of inflation. And that's his justification for having really low rate given where inflation is. And yet what we're seeing at the same time is a slightly tariff-induced inflation spike and an energy-induced inflation spike laid on top of it. So cutting into that scenario would be very weird indeed. And I think that would really question the Fed's independence. And markets would not take that well.
Do you think we could see the first instance of the Fed chair being outvoted? So the Fed chair voting to cut and the rest of the board not going along with it?
I think it's possible. And it would also discredit Walsh because if that's the case, most people would know. I mean, just look at the Fed dot plots. These are the summary of economic projections. You can see how each member voted. And you can see another member of the board, Stephen Moran, he's consistently voted for a cut. And that's often been at odds with the rest of the voting members. So will Walsh do the same thing? Well, that'll look awful, I think. The optics of that would just be atrocious.
I don't know if he will, though. He's been on the Fed board before. I think he knows how to play the game. And I don't think it's actually a given that he's going to get put in place as the Fed chair. Trump can change his mind on these things if he gets the sense that Walsh is not going to go big on rate cuts.
Maybe he'll just swap them out for one that will.
If you look at the betting markets like Kalshi, Walsh is actually 95% likely to be the next Fed chair. So a small chance that something goes wrong.
But as we've said many times, the difficulty facing central banks is a stagflationary shock. One in which you have lower growth and higher inflation is one in which their hands are tied. And most central banks will go into wait and see mode. They'll see which of those two opposing forces are going to be more important and whether this inflation spike becomes embedded and anchored.
Do you think it will?
I think it will. I think people are still very sensitive about inflation, given what we've just come out of, a huge inflation spike. And that's going to make people think, oh, look, this is just going to be more of the same. And it hasn't stopped. Things were just getting better and now prices are going up again. I can see that every time I fill my car.
I just wonder if they're going to have the bargaining power to push up wages again. And if companies are going to have the power to put prices up again.
Yeah, there'll probably be some combination of lower margins for companies and also, I think, some anchoring of inflation expectations higher. But you're right, I think in terms of wage negotiation, particularly for people whose jobs are at risk due to AI, that's going to be difficult to negotiate a higher salary.
But in terms of market expectations, it doesn't look like the market's expecting a massive sustained inflation spike again.
Yeah, if you look at inflation swaps, there's not much being priced in terms of sticky high inflation. Certainly not for the US.
But from what you're saying, you think that's complacency.
But if we do look at the UK, inflation break-evens have bumped up a little bit. So pre-Iran war, we were looking at around 3.2 across the curve. And then for the 5 year, it peaked at around 3.9. So certainly more inflation's priced in, but it has fallen off that peak now.
But don't you think our track record in the UK of managing inflation is not as good as people commonly think? The inflation target is 2%, but since 2010, we've averaged 3%. And that's over a period following the financial crisis where demand was depressed and people were talking about, we're going to undershoot. Well, we haven't over the long term. I know we had the big inflation spike, but there's always going to be spikes, right? You've got to average it over a period of time. If you're basing your financial plan in the UK on expecting 2% inflation, that looks suspect to me.
Yeah, whenever I do a simulator, I always assume 3. Maybe if I was in the US, I'd put it lower. But I think you're right. I think the Bank of England hasn't done a great job of keeping inflation under control, largely due to the nature of the economy, I think. It's not all blame that we can lay at the feet of the lady of Threadneedle Street.
So what does all this mean for the bond market then? Yields have gone up since the start of the war, come down a little bit since the ceasefire was announced. But what are they pricing in at the moment, and what are they not pricing in?
Yeah, there are two conflicting forces here. Lower GDP growth tends to push down yields at the longer end of the curve, and higher inflation pushes them up. So those are the two competing things. But what we have seen is the entire curve moving up. And that's, I think, because inflation was winning. Now, there are opportunities there. If you're someone who's thinking about buying gilts, for example, there are some really good opportunities to do that. And I know that some large investment banks have been recommending just that. They say, look, lock in these yields because they're likely to fall. And I do get questions about this in the YouTube comments and one-to-one. And I'm kind of kicking myself because I didn't buy gilts when yields did spike as they did earlier. And particularly at the short end of the curve, there were some really attractive opportunities. But it's still the case now that if you compare short-dated gilts with money market funds, the yields are now very attractive compared to where they were in February, say.
Why is that? Is that just the market expecting a rate hike or two over the next year?
Yeah, that's the massive shift that we've seen in expectations. And I think that was a little bit too overdone. So that's why I was kicking myself that I didn't kind of jump on it when it happened.
You might get another chance if Starmer gets pushed out and you get a more fiscally loose prime minister. Maybe the bond market will give you another opportunity.
No, I think you're right. I think you're right. And you've got to make the best of these opportunities when they arise.
I guess if you did believe what some commentators think, including perhaps Kevin Walsh, who's coming in at the Fed, that tech and AI over the long term is going to be a big disinflationary force, and all else being equal, push yields down. And if you go out to the longer end of the curve, where yields are almost 5.5% in nominal terms and above 2% in real terms in the UK, that could potentially be an opportunity. I think we've said it before, haven't we? That, if you expected a depression, for instance, that would be a huge opportunity. With the duration of those things, you'd have a massive rally in the prices of bonds at the long end of the curve, were that to happen.
Yeah, I mean, you'd be YOLOing TR73, the 50-year gilt. But personally, I keep away from old man's crypto. I don't do that. But yeah, I mean, you could take a punt on it if that's what you believe.
A lot of these all-weather style portfolios will have a significant allocation to long-term bonds because it performs so well in any kind of deflationary shock.
That's right. That's right. If that's what you expected to happen, if it was deflation, then yeah, I mean, that would be atrocious for the economy, but great for those bondholders.
Or anything that pushed yields down to like 1% would be a massive gain for the long end of the curve if you held those bonds.
Yeah, it's been so volatile over the last 3 or 4, 5 years that it's hard to call bonds boring in that kind of environment. Personally, I wouldn't take a punt on that. I'm not convinced about the argument about the disinflationary forces. I'd rather see that before buying into it.
Yeah, I know what you mean in terms of taking a punt. But if you're building a kind of all-weather portfolio, because some people look at the markets right now and go, everything's expensive. Well, this is a corner of the market that wouldn't be expensive if that scenario played out. And that's precisely why it usually has like 20 or 25% of a portfolio that's built to weather any storm.
Yeah, one of my experimental core portfolios has some of that long duration stuff in it. And yeah, it's done okay. That's been great, but it's been good. But as you say, that's by design. You can't forecast this stuff, and there will be environments where it does well.
I mean, the 40-year period up until 2022 being a long example of that kind of period.
But if we're thinking about YOLO trades, I think another one that lots of people have been playing around with is to do with oil, going for these levered oil products and gas products. And I think that's been very difficult to call. If you listen to energy analysts, they're surprised by how sedate the response has been in things like the gas market, given what's going on in terms of supply. So even professionals can't call it correctly.
It feels weird that we've had such a big fall in oil and gas prices, given that ships are still not really flowing through the Strait of Hormuz. There's a blockade. There's a double blockade on that strait, right? This crucial strait. And the thing I think goes underreported is the lag effect. So everyone's focused on, are ships coming out of the Middle East? Are they exiting the Strait of Hormuz, coming out of the Gulf and delivering their oil? But maybe the bigger issue is there's no ships going in. So even if you open the strait, it's going to take ages for all the tankers to get there and get in and collect the oil and deliver it to refineries. Now, I don't want to say the market's wrong. I don't know anywhere near enough about the energy market to say that. And as you know, professional traders can't call it. But there must be upside risks to the oil price.
Yeah, I kind of agree with Gideon Rachman here, which is that this is just the beginning, I think, of what could be a very prolonged conflict.
You know what I saw a few people saying, which I thought was quite interesting, Roman, is that the right framing at the moment for investing is believe what Trump says. Now, you might think that's mental, the biggest liar in the world. Why would you believe what he says? But they say he's so focused on the stock market and the oil price and gas prices that if he says things are going to be okay in 3 months' time, just believe him because he'll do what it takes to make it okay. Maybe that's what markets think. Like if Trump can ignite a massive risk-on rally with a tweet and saying Iran have agreed to all these things, which they haven't, supposedly, then you don't want to get caught short, do you? You'll get your face ripped off.
Yeah, I think another twist on that is not to sell America. Because if you've tilted away from the US, then you won't benefit from all of that power, which is funneling good news into the US equity market. Even if some of it's not true, as long as the market believes it, that's what matters.
I would have thought by now the market would have just started ignoring Trump, but that hasn't happened.
I remember in his first term, it got to the point where every time he made an utterance, markets sold off. And we're not quite there yet. As you say, it's still very much rallying based on what he says and still rallying when he says things which should make it rally.
So what do you think could break this narrative? What could cause a severe market sell-off?
Oh, lots of things. I mean, we mentioned credit earlier. If that starts to wobble, and it's often the case that credit markets are sensitive to bad news, more so than equity, and then they remind equity that things aren't great at all. So that could be one possible source. Another one would be some kind of expansion of the war. For example, if China desperately needs oil and it starts escorting tankers through the Gulf, well, that would essentially be a conflict between the US and China, which is a whole different ballgame. I'm not saying that's likely, I'm just saying it's a possibility, but that would certainly make equity markets sell off. And then the final point, which is a boring one, is that if it just extends for longer, this crisis, markets are going to have much more difficulty, I think, seeing the upside. At the moment, it's still the case that people are saying, oh, we can look through this. But eventually, that's not going to be a narrative that works when you're 2-3 months into a conflict.
At some point, the oil's got to start flowing again. The barrel must flow. Like, otherwise, the planes don't fly in Europe, right? Like, it has to happen. We can't pretend forever.
And countries which do have strategic reserves, like China, eventually are going to have a real problem keeping the wheels of their economy quite literally turning.
Base case, though, the world muddles through.
Well, that's usually the base case, and it's worked pretty well so far. All I'd say is if there are sell-offs in this market, then if you are dollar cost averaging in, that's not going to be a bad thing. And now that we're at all-time highs again, if you haven't de-risked and you're someone who realizes that they probably should have de-risked, well, it's not a bad opportunity to do that.
Yeah, I think we all just want the war to be over, peace to reign, so we can just go back to worrying about private credit and equity market valuations and AI. That's the world we want to be in.
Oh, happy days. If you're worried about stagflation, about oil prices, about geopolitical shocks, and how to invest as a result, then you can discuss that with other investors as part of our community. Just go to pensioncraft.com/membership.
Okay, today's dumb question of the week. What is the crack spread?
Now, I'm a physicist, right? So I don't like the C word, but I did have to do chemistry when I was at school. And the only bit which I really enjoyed was when we actually got some oil and we put it into this fractional distillation tube. And you could actually crack the oil into its different fractions. So you get the heavy stuff at the bottom, which was like tar, and you get the light stuff at the top, which was really kind of volatile, light colored products. And that's just a beautiful description of how oil is processed. So think of the crack spread as a difference in price between the stuff that comes out of your distillation process and the stuff that goes in, the raw material.
So what we're saying is the crack spread is the difference between the crude oil price, which is the input to a refinery, and the petroleum products that come out of it. It's things like diesel or jet fuel.
Yeah, and the process is called cracking. Fractional distillation isn't so snappy.
Now, why should we all worry about the spread of our cracks right now, Romin?
Now, this would be irrelevant if it was the case that you could just pump oil out of the ground and just put it into your car. But of course, you can't. It has to be one of those fractions that comes out of these refineries. And the crack spread is what accounts for the difference between the crude price, which is driven by supply shocks, and the refined price, which is what people pay for the stuff that comes out of the refinery.
And the crack spread has blown out, hasn't it, since the start of the war? So crude prices obviously went up a lot, like 40% or something. But if you looked at the price of petrol, diesel, and particularly jet fuel, that went up even more because the refiners were able to charge a higher price for those refined products. Well, why was that? Well, because a lot of big refineries in Asia were no longer able to get the crude input, so had to shut down production. So a lot of the refineries in the rest of the world were just able to charge more money.
Now, there's a lag effect here as well, because the prices that the refineries are paying for the stuff that went in is still the elevated price. So there's a kind of lag effect on the output of those refineries. There's also a point about the quality of the oil that's being refined. And for the US refiners, they're getting an extra bonus. And that's because their input is WTI, which is their local oil. Now, that's been physically insulated from the Strait of Hormuz risk because it doesn't come through the strait. So if you compare it with Brent, for example, which has, well, there's a huge difference between the two. So if you were an owner of a US oil refinery right now, you'd be very happy indeed.
Now, Romin, you know I'm a fan of ETF tickers. There is a ticker, CRACK, which tracks US oil refiners, and unsurprisingly, that is up massively. So the NAV is up 30% versus its pre-war level and almost 75% over the last year. Refiners are printing money right now.
Well, I guess what we might be looking at here is Trump achieving what was one of his goals, which is to put US oil front and center of the global economy and for it to benefit the US economy.
Well, you started the dumb question with a C word and you ended it with a C word. Thank you for joining us for many happy returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.